Hello, and thank you for joining me today. Subject of the chat today is Boohoo. Now, the reason I'm interested in Boohoo is, first of all, I do hold this position in my portfolio, and it's one of the largest holdings, one of the largest two holdings actually, along with Alibaba. Secondly, I did quite a popular video around about 3 months ago, which analysed the last set of quarterly results. So I want to refresh that view, have a look at the most recent results that were released towards the end of last week, and kind of see, as a result of that, what action that I've taken and whether I think the company is still, a suitable long-term investment. So that's the plan for today. Now, if you stick around to the end, you'll see my view on the valuation and how this sits in my portfolio. Stay with me. So we're going to have a look at a few of the key principles to start with. Now, first of all, what I'm looking for going forward, this is something I've adopted relatively recently, is investments to double in 5 years, or within 5 years. And that compounded is a 15% per year annual return. So that's the objective. So I want to look at Boohoo in the context of that objective. I'm going to start off with the most important thing, which is Warren Buffett's rule number one. Rule one is do not lose money. And that can take two forms. So the first form is an absolute loss of capital because the company fails. And the second view could be actually going in at the wrong price points, not having that margin of safety. And therefore, you actually bought too high and you never end up making sufficient amount of money from the investment, or even losing, but not because the company's failed, just that the market price hasn't performed. So I want to start over here on Morningstar. Morningstar is useful for seeing a very long-term 10-year trend. The financial health tab here under key ratios, we've got first of all the current ratio, and that current ratio, even with the most recent results, is always above 1, certainly since 2014 onwards. So that suggests that they're able to pay their bills in the short term, so there's less chance of going under. And also the debt to equity, that debt to equity is very, very low. And with the low debt to equity, that suggests that a low level of debt, very low chance of actually failing. I've just switched over to Simply Wall Street for graphical representation, and we can see here very, very low debt levels, although there is a touch of new debt there at 50 million, so insignificant amount really. And that balance sheet looks very good because the cash and short-term investments is treble the value of the debt. So I'm absolutely clear that this company is very, very unlikely to fail. Now, of course, this is only my personal opinion. None of this is a financial advice, investment recommendation. You should always do your own research. The Warren Buffett think of, would you be happy to not have a quote on this company for 5 years if the stock market was shut? On this basis, yes, because they think they're very unlikely to actually fail during that period. So the second thing then is to look at what's happened in recent months, because this company's had a lot of change, and then we'll go into the most recent results. Have a look at Google, and we go back to Friday the 19th of November, which is a month ago. £1.90, so almost that £2 level. And when the results came out, they've now dropped down 45%. And they went down to around about £1 per share. So there's a massive drop off in the share price in that month. Before the results, they were still trending down anyway. They were just around 140. So the results, they dropped to almost 25%. So what we need to assess is, are they 25% worse today than they were a week ago? So let's have a look at the results and see what's going on. So if you are an investor or considering investing in this company, I'd urge you to read this document. It is only 4 pages long, so it's a nice kind of easy read. The information is quite clear. Update to the end of November 2021, so very recent. First of all, gross demand growth has exceeded what's achieved in the first 2 quarters of the year. And they kind of talk about gross demand because there's actually then the net demand, which I think nets off the returns, which is quite a big issue for them. So the expectations for the current financial year, of which we're 3 quarters of the way through, has been lowered. And that is why, in most likelihood, the market price has dropped dramatically in the last couple of days. I'm talking about here the higher returns, so that impacts the net sales and also increases costs. And the international side has been hit by some of these logistics. And of course, we've got higher inflation all around the park at the moment. So looking at these numbers, they quite cleverly put a 1 year and a 2 year change because the 2 year looks really good. But let's look at 1 year, because my view on these investments is if things can change quarter to quarter, we shouldn't have a knee-jerk reaction to a company just based on 1 quarter's bad earnings or a negative change in a quarter. If we look in this 5 year horizon, has the outlook for this company in the long term, over 5 years to double your money, has that materially changed? That is the key question. Now, they're talking about things such as international travel. Now, we know, first of all, there have been delays in shipping. That isn't their fault. have been massive increases in cost in shipping, I would suggest that is probably temporary, although it could be 6 months, it could be 18 months, probably somewhere in that region. Inflation's very high, and it was the same in the recession, sort of 08, 09. After that, we had a period where there's much higher inflation and commodity price increases, but then it all settled down again. They can't control the returns rates, or maybe they can tweak their terms and conditions policies, but there's only so much they can do there. So I think the changes here that they've said are affecting them. If that is indeed what's impacting them, they are very likely to be short, medium term in nature. I don't think it impacts the long-term ability of this company to perform. It could be unlucky and you could have high shipping costs for 5 years maybe, but then all companies will be impacted by that, and you can't really legislate for that because there's no evidence to suggest that this will be the case. So in the year, net sales, so net of the returns, is up 10%, which is very disappointing as a standalone number because they've generally been going at 20 to 30% every year. But if we dive into that detail, that's the 3 months, 30th November, and it's similar for the 9 months from the financial year. 32% growth in the UK. So the core market, the largest market, which is almost 900 million of almost 1.5 billion in revenue, that is growing 32% net sales rather. Very impressive continued growth, and I don't think we've seen the full impact of the Debenhams acquisition and a few of those other brands they bought in as well. So I think there's still further upside there. And you can see here it's the sort of international, makes sense with the logistic delays and increased costs, what have you. So that's kind of offsetting that very rapid UK growth, but the biggest market is still growing rapidly. That is really good news. And that's not just the 3 months, but also in the 9-month view as well. The interesting thing here, that gross sales up 28%, net sales just 10%. That's a massive difference in terms of those returns. So that I can see why that's impacting them. So I think overall, their actual sales and the growth of the company, I don't think it's as terrible as saying, well, this company's now worth 25%. So release this information, the market's dropped the value by 25%. I don't think the long-term prognosis of this company is 25% worse. I think that's a short-term overreaction. Long-term, management have not done anything bad here, from what I can see, to cause these results. These are factors outside of their control. Actually, speaking of management, look at this. So the co-founder's still there. He owns 16%. The other co-founder's there, 2.5%. So they've got ownership stakes between them worth $250 million. Market cap is 1.4 billion, and therefore that is a big proportion. So we're talking around about a sixth is owned by the founders. There's no selling, so they're not knee-jerk reacting. They're not overly worried because they would be selling some of those shares. There's no insider sales in the last year, only purchases. Although we're going back 6 to 9 months there, but all these purchases have been at much higher prices, in the £3 range mainly. We're now at barely over £1 a share. So if you add up all the individual insiders, that's almost a quarter of the company. So I'm saying here, look, we've got factors outside their control. Management own massive stakes, and this share was £4 at some point last year. It's now just over £1. So they've lost 3/4 of their kind of stake in the company. They haven't sold out. They want to keep going. They've got loads of skin in the game. Doesn't look like they've done anything particularly wrong. There's still lots of growth there. So I don't think this is as bad as the price change suggests. And look, we've still got this strong balance sheet. There's plenty of liquidity. Net cash is 70 million. Now that is a bit lower than it has been in the past, but they have made these various acquisitions and they have actually spent some capex to invest in improving their distribution. You see that here. They're looking at that US distribution centre, which will go live in 2023. So they're planning long term. So yeah, this year, those net sales, 12 to 14 instead of 20 to 25. So you're almost halving the net sales growth for this year. But it is still growing, and it's a low risk company in terms of likelihood of failure. Yeah, margin guidance down, totally as you'd expect given the announcement. And very interestingly, look, according to the group CEO, they've gained significant market share during the pandemic. So long term, they'll be able to leverage that position. And it's not like they're losing money either. A lot of growth companies, or this is now a few years into that, they are buying market share at the expense of making some money or having, taken on lots of debt. This company's growing fast, but their balance sheet is still really good. So it's very impressive the way they've done this. So a little problem with the camera there, which seems to be cutting out. So hopefully it's all right for the rest of the video. Just to re-emphasise that point, there's plenty of notes here around sort of freight and logistics being challenging for cost and availability. So look, I'm far less concerned than the market is. And remember, the market in the short term is a voting machine. So this stock is not popular at the moment for the potentially part of the reasons we just looked at. In the long term, it's a weighing machine. So if they keep growing, keep that strong balance sheet, keep growing your market share, in the long term, this company will improve its market price. But in the short term, never bother trying to predict what's going to happen because you just don't know what's going to happen. Just flicking back to Morningstar, then just a quick reminder of that sort of long-term 10-year view. Now you have a look at this. Look at this revenue growth over time: 67 million, 2013, 110, 140, almost 200, almost 300, almost 600 billion, 850, 1.2 billion. 1.7, 1.9 billion. So they're still growing revenue. They're growing it really, really well. Yes, the income hasn't risen as fast as the revenue. Generally, that's what you'd expect in a growth company, but net income is consistently positive. They're making tens of millions of pounds, and they haven't particularly issued that many more shares, which again, a lot of growth companies will do as a way of raising capital without taking on debt. As discussed in those earnings, there is a bit more capital expenditure. So the free cash flow, for the first time since 2017 numbers, is actually negative, but that is a temporary negative due to the extra capex for the distribution centres, for example. And if you look at my video from 3 months ago, there's some more notes around what they're spending money on. So they look pretty good. Price to sales now is less than 1. You're looking at a 1.4 billion market cap, but they're selling 1.9 billion. So I know price sales isn't the most scientific way of valuing a company, and it shouldn't be a primary method, but it's just an indicator on a growth company. And yeah, you've got a price to sales of less than 1 here, considerably less than 1. I think it's worth thinking, well, what's the long-term goal here? What are they aiming at? So they're aiming for a network capable of delivering 5 billion of sales, net sales, and returning towards 25% year growth post-pandemic. Now, of course, they might say that, but the evidence suggests in prior years they've been able to deliver against those sort of objectives, that level of growth. They're not just quoting numbers. Growth companies, they like to give you the good story, but there's not necessarily the evidence. Here, there is evidence of this level of growth in the past. And you see here, past performance, simply bullshit. They've calculated that in the last 5 years, 28% a year. They're saying 25% a year going forward. That is pretty believable. We've got some analyst view here that say, in terms of earnings, next 3 years, 22 analysts. That's really good coverage. 35% a year. So if you've got a P ratio that's lower than that forecast growth rate, I think that's the P to Lynch ratio, the PEG ratio, less than 1, then that looks potentially undervalued. We've got here PE of 23, PEG 0.7, and that's against this 35%. But even if it's 25%, which they're saying, even if you had to knock a few percentage points off the overconfidence, you're still looking at PE a PEG, of around about 1. So I think it's at least reasonably valued. And if they do get to that 5 billion, now they're saying capacity of 5 billion, so maybe you say 4 billion. They get their 2 billion today. Let's say they get to 4 billion of sales. Now their medium-term margin guidance is 10%. They talk about EBITDA. I prefer them to talk about profit, but let's talk about the EBITDA here. So 10% of that, so that would be 400 million of EBITDA. When they get to those 4 billion of sales, and a 400 million of EBITDA against a market cap of 1.4 billion, that is a forward ratio there of 3.5 if you divide the market cap by the EBITDA. Generally speaking, less than 10 is quite interesting, certainly for established companies. If they do get to the levels that they say they're going to get to, the enterprise value to EBITDA looks quite attractive. So if we have a look at the longer term chart here before we go into my holdings, look at this, just over £1. The last time they were this price, you are talking pre-Christmas 2016. So this company was last this cheap in terms of market price 5 years ago. 5 years ago, they had a revenue of 263 million. So that is what, 7 to 8 times smaller than today's revenue, somewhere in that region. They've grown from there all the way in that, and they're still the same value. Now, of course, some of that growth was baked in, but that does suggest, this is a good opportunity here. And it has been volatile with all bits of news that come out, but this seems like a total overreaction. Over £4 18 months ago. This company is not a quarter as good as it was 18 months ago. That seems an overreaction. I think certainly this will get to £3 again in the long term. I'd expect it to get to at least £4, probably £5. And the upside, £4 to £5 compared to the current market price, is very high. Now, if you're very lucky, you've never bought this and you're thinking about buying it, and you do your research, you buy at this price, you've got an absolute steal deal, in my view. I started my position a year ago, a little bit too early. I always thought at that point it was going to be a £5 stock. So we're going to have a look at ShareSite just to see what's been happening in my portfolio, which is here. So I bought at 334, but based on the ruling that I've adopted sort of as we're going through this year, double in 5 years, I thought it was £5 to £6. So actually that was a mistake for me to buy then. I should have waited till it was £3, but it dropped off from £4. actually went too soon. I broke the Peter Lynch rule of being in a rush to buy a stock. So it's a message to myself there. Should have waited till at least it was £3. But I've averaged out there £2.70, £2.54, £2.11, 187 coming into October this year, 171. I bought some at 147. I thought that was a great result. And then the earnings came out and I bought some at £1.02. Now this now is an average cost of, where are we, £1.89. So if I'm saying it's a £4 stock, probably at least in the long term, there's a double there. But the cost base is 4,200. So that's actually about 10% or so of the portfolio. So that is absolutely maxed now from a risk management perspective. So I'm not too overexposed to one stock. Rule one, don't lose money. Pretty sure this won't fail, but I could be wrong. So I don't want to put too much into one company, because if I am wrong, you lose money, it sets you back so much in terms of your long-term return. So I've maxed out from a risk management perspective. But I'm very happy with the size of the position and also the average, which is well below £2. Minus 43% at the moment. That looks terrible. It's really dragging back the portfolio performance, as is Alibaba, because that's the second biggest holding. So got some really big holdings, really good, strong, large growing companies pulling back my overall performance. But look, it looks bad on a portfolio review, minus 43%. And on that note, at the end of the month, I'll do the full portfolio review and performance of all the holdings, and also how it's all gone this year, whether it's on track. See that in a few weeks' time. But it's a long-term game, this. It might be 43% down now, but look, this drop has enabled me to reduce my average from £3.34 when I started all the way down to £1.89. So that's been great. By the way, if you do like this tool, with its compound annual return figures, cost averages, all your views, there's even got news, etc. in here. If you do like this tool, then I'll leave a link in the pinned comment below for share site. You get a discount if you use my link, and it also gives something back to me as well. So I'd appreciate it if you consider doing that. And just as a last sort of sense check, I do like to head into Simply Wall Street just to see what their valuation metric is. Not that it's kind of necessarily rock solid in terms of you should always look at this, but it gives an indication. They're saying 326. So that's obviously quite a big upside there. And yeah, look, it may go down even more in the short term. We just don't know. But if there's more lockdowns that are coming in, which lots of countries are doing, loads of shops will be shut, but these guys don't have shops, they're all online, so they could benefit a little bit from that. It should give them a little short-term boost. But in the long term, things are still looking good. The costs and the capex will settle down. They seem to be doing well, still growing, good insider ownership, very low debt, strong balance sheet. It looks like a steal deal to me. So this is probably the last video I'm posting for Christmas, so Merry Christmas, have a really good time, have a good rest, and yeah, I will be back just after Christmas. I've got quite a few things planned, see the full year and the portfolio reviews. I've then got some interesting videos coming for new investors, so stay tuned for that. If there's anything you'd like to see on the channel in particular next year, going forward, then drop a comment below and I'll have a look at it, see whether we can incorporate it. That's the review, and thanks for a couple of you that have asked for this. Let me know what you think below.